Could it be that the tax system is skewed in favor of the ultra-wealthy? This question has fueled the debate surrounding President Joe Biden's proposed tax reforms, a debate that has been raging ever since the announcement of these reforms. In the summer of 2021, President Biden's administration unveiled a series of tax proposals aimed at addressing what they perceive as inequities in the tax system. The plan proposed several notable changes, primarily aimed at increasing the tax contributions from the wealthiest Americans. One of the most controversial suggestions was the taxation of unrealized gains and an annual 2% tax on trusts valued between $50 million and $1 billion. Additionally, the plan proposed substantial incentives for homebuyers, which ostensibly support middle-class families. The underlying rationale for these tax changes, according to the administration, is to combat racial inequity and support the middle class. However, there have been concerns that the actual impact could be quite different. Critics, including financial analysts and economic commentators, suggest that these policies might not effectively target the ultra-wealthy, who often have the means to avoid higher taxes through sophisticated financial planning and asset management. It's a well-known fact that billionaires and multimillionaires have substantial influence and resources. These resources can be mobilized to circumvent new tax liabilities, potentially undermining the effectiveness of the proposed reforms. For instance, rather than paying a 25% tax on unrealized capital gains, a billionaire might choose to invest in real estate or other depreciating assets to reduce their taxable income. Beyond the potential for tax avoidance, there are broader economic implications to consider. The proposed tax reforms could discourage investment by increasing the cost of capital. This could lead to reduced job creation and economic growth, particularly affecting small businesses and entrepreneurs who lack the financial clout of larger corporations and wealthy individuals. Moreover, the proposed elimination of benefits like the 1031 exchange, allowing investors to defer capital gains taxes on property if they reinvest in similar properties, could decrease real estate investment, impacting local economies and property values. The long-term effects of these tax reforms on economic inequality and wealth distribution are uncertain. While they aim to generate more government revenue and reduce deficits by targeting the wealthiest Americans, the actual outcomes could depend heavily on the implementation details and the ability of wealthy individuals and corporations to adjust their financial strategies in response. As the debate over President Biden's tax proposals continues, it is crucial for policymakers and the public to consider both the intended and unintended consequences of these reforms. While the goal of reducing inequality and supporting the middle class is commendable, the effectiveness of these measures in achieving such outcomes remains to be seen. In conclusion, the debate on President Biden's tax reforms is a testament to the complexity of the tax system and the challenges of wealth distribution. While the proposed changes aim to address perceived inequities, their potential effects on wealth distribution and the economy at large are far from certain. Whatever the outcome, this debate underscores the need for a comprehensive understanding of tax policies and their broader social and economic impacts.